Hey there, and welcome to the channel. In today's video, we're gonna be taking a look at the latest earnings report for Alibaba, which is a Chinese e-commerce company. Now, like with most of the companies that I talk about on this channel, I am a shareholder, so you have to take everything that I say with a grain of salt. We're gonna start the video off by going over the latest financials. We're then gonna take a look at some of my highlights from the earnings call, and we're gonna end the video by looking at the key ratios for the company, which is something that I do with all of my portfolio companies. But before we get into it, I do want to ask you to smash the like button and subscribe to the channel if you haven't already. That is to say, if you get any value out of the content that I'm providing. And also leave a comment below if you have a company you want me to take a look at and possibly make a video about. Now, it has not been easy to be a shareholder in Alibaba, which is currently trading at a similar stock price that it did in their IPO. And I believe the current stock price of $74 is slightly below the IPO price, which was around 78 or 77, I believe. Now, I personally started to buy into Alibaba at a higher price than the current stock price, unfortunately. I remember when I first bought into Alibaba and I was buying them at a 7% free cash flow yield, which I thought at the time was a pretty good deal. If you look at it from the view of a business owner, which is something that we should always do when we're buying into companies in the stock market, the company has a market cap of $190 billion, and they have about 63 billion or so in net cash, which means if you take all the cash that they have, deduct all the debt that they have, their net cash is 63 billion, which gives them an enterprise of about 130, 127 billion or so. And their trailing 12-month free cash flow is 27 billion. So we can see that their enterprise value to free cash is less than 5 times, which gives us a free cash flow yield of 20%. Now, normally you don't get a free cash flow yield of 20% unless there's something really wrong with the company. Either they have a very unhealthy balance sheet, they owe too much and will probably go bankrupt, or they're just losing money way too fast. But in this case, I do think it is the China discount that is giving us a free cash flow yield of 20%, and the fear that the CCP might just take over the company. But if you think about a 20% free cash flow yield, you don't need much growth, really just growth around inflation or just above that, 3 to 5% will give you a very decent return when the discount goes away, when and of course if the discount goes away. So let's start digging into the numbers, and the first thing that I highlighted from their September quarter of 2023 was this announcement of the annual dividend for fiscal year 2023, which is about 2.5 billion. I think that's around $1 per the ATR share, which honestly I don't think is a really meaningful contribution to the shareholders that have stuck through the tough times with the company. And in my opinion, the company should really pay out a hefty special dividend to reward the shareholders. But looking at the business highlights for Alibaba, their revenue saw a decent growth of 9% year over year. Their income from operations grew at a much higher pace of 34% year over year. And of course, they are excluding share-based compensation in their expense from non-GAAP measurements. But Alibaba has been notorious in paying way too much in stock-based compensation to their employees, which means that the share buybacks that they've been announcing have only just been not to dilute shareholders too much. But being invested in Alibaba has been a good lesson in looking really hard at the share-based compensations and also deducting them from free cash flow when you're trying to figure out the intrinsic value of the company, just to see the difference between the free cash flow with share-based compensations and without. And the company excluded net gains or losses in the changes in fair value of their investments which is something that I agree with. And they saw their net income increase by 19%, which is pretty impressive. Now, the reason that I agree with management is because if you're trying to figure out what the real net income is for the company, it really doesn't matter what the changes in fair value of their investments are because they haven't sold their investments. So it's a non-cash change. Now, free cash flow is, in my opinion, the most important metric to track for the intelligent value investor. And the company saw an increase of 27% in their free cash flow, and they generated 6.1 billion in the quarter, which is pretty impressive. Now, the next thing that I highlighted in the report was yet another reason to be pessimistic about their cloud segment. But the management is talking about the impacts of recent US export controls expansion, where they believe that these new restrictions may materially and adversely affect Cloud Intelligence Group's ability to offer products and services and to perform under existing contracts, thereby negatively affecting our results of operations and financial condition. It is safe to say that we've been pretty disappointed about the performance of the cloud segment, and this is not something to give us hope for the future. And also regarding the spin-off of the Cloud Intelligence Group, is that the management is not going to be spinning off the cloud group because they don't believe it will achieve the intended effect of shareholder value enhancement. Basically, the management team doesn't think they can get the fair value for the cloud group, which is something that under the current market conditions is probably correct. But more news on spin-offs and capital raising is that the Alibaba International Digital Commerce Group is in preparation for external fundraising. Now, this group consists of companies like AliExpress, Alibaba, Trentinol, and Lazada. Now, the Now Smart Logistics Network has applied for an initial public offering in Hong Kong and has submitted its filing to the Hong Kong Stock Exchange. So we might see some news on that in the coming quarters. And Fresh Hippo, which is one of the grocery chains that Alibaba created, has put their plans for a public offering on hold, and is probably a similar reason to the canceling of the IPO for the cloud group just because of market conditions. Alibaba bought back $1.7 billion dollars of shares in the quarter, and they still have 14 billion remaining in their share buyback program. But in my opinion, the company hasn't been nearly aggressive enough in buying back shares, seeing as their intrinsic value has been way above their share value for the last couple of years, at least in my opinion. Alibaba splits its business basically into seven parts, with the core business that makes most of the money for the company being Taobao and Tmall Group. Then you have the group that I talked about earlier, the Alibaba International Digital Commerce Group. Then you have the Local Services Group, which is Ely.me. Then you have a map, which is something similar to Google Maps. Then you have the Caninao Smart Logistics Networks, the Cloud Group, the Digital Media and Entertainment Group, which is Ali Pictures and Youku, and then all others. And all others consists of companies like Sunart, Freshippo, Alibaba Health, and DingTalk, just to name a few. Now, if you go over the performance of each of these groups, the core business grew by 8% year over year, and that's comparing the 6 months ended in September 2023 compared to the same period in 2022. Now, the company saw a very healthy growth in their international commerce group of 47%, which is pretty impressive. The local services group grew by 22%, and the Caninao Smart Logistics 29%. And like I mentioned earlier, the cloud group keeps on disappointing shareholders with a growth of only 3%. Digital media grew 21%, which I was surprised to see. And finally, the others sector is not growing at all, with revenues being flat. So let's take a look at the EBITDA for these seven groups. And it is pretty interesting to see that the core business, Taobao and Tmall Group, actually make up an EBITDA of 13 billion compared to the total segment EBITDA of 12.5 billion. Now, when I initially invested in the company, I saw that this was happening, but I just thought that soon enough, all of these companies would be making enough money, seeing that they were growing really fast. So the total EBITDA of the company would not be carried by just the core group. But for some unbelievable reason, the Alibaba International Commerce Group is still losing money of 110 million dollars for the 6 months ended in September. The local services group is losing even more money of 623 million. Caninao group is making about 244 million. The cloud group 319. The digital media and entertainment group is only losing 19 million. And the all others group is the second most loss-making group, losing 435 million. Now, this is something that I was talking about earlier with the total share-based compensation expense for Alibaba that has been going down as a percentage of revenue, but the share-based compensation expense for the last quarter was 936 million, which is 3% of revenue, compared to 4% of revenue for the same period last year. Like I mentioned in the intro of the video, the company has a very healthy balance sheet where they have a cash position of $85 billion. Now, I've heard some rumors on Twitter where people have been speculating about Alibaba counting money from the Ant Group, which they own one-third of, and basically putting cash that the Ant Group has into their own balance sheet. Now, I don't know if that's true or not, but that is the rumor. Taking a look at some of my highlights from the earnings call, here you have Joseph Tsai, which is one of the founders of Alibaba, has come back into the chairman's role. Here he is talking about the return on invested capital, which has been in the single digits, and obviously there is room for improvement, where they are targeting to lift the company's return on invested capital into the double digits. I did talk about earlier in the video that Alibaba should do a special dividend to reward loyal shareholders, but Joe Tsai is asked about it on the earnings call, where he says that the company is not going to consider a one-time cash dividend. Now, when the company has such low return on invested capital, they really should think about giving the cash back to shareholders, unless they are able to execute some kind of plan to increase the return on invested capital, like Joe Tsai was talking about earlier in the earnings call. Now, I want to end the video by going over the key ratios that I track for my portfolio companies. And I am fortunate enough that Guru Focus updates these numbers for me, so I don't have to do it manually. And Alibaba's 1 year free cash flow growth rate per share has been pretty decent at 34%, although we are comparing it to a pretty low base in 2022. But if you look out further, their 3 year free cash flow growth rate is 8%, which is decent, but they have an even lower growth rate when we look at their 5 year free cash flow growth. Now, like I mentioned in the intro, the company is ridiculously cheap, both on an enterprise value to free cash and a price to free cash. The return on invested capital is still too low, like Joe Tsai mentioned on the earnings call, but is at least higher than the 5 year median. The same thing can unfortunately not be said about the return on capital employed, which is 11% compared to the 5 year median of 14%. And the return on equity is also lower than the 5 year median. The gross margins for the company have been going down for the last 5 years, and the same thing can be said about their operating margin. Their free cash flow margin is pretty decent at 23%, but still lower than the 5 year median of 26%. Now, like I mentioned earlier in the video, the company has a pretty healthy balance sheet. And I would say, to wrap things up, that I'm pretty happy with the quarter, being a shareholder in Alibaba, but my investment thesis in the company has definitely changed since I invested for the first time in 2021, where I thought I was buying into a wonderful company at a fair price, but now I'm actually just holding the shares in a decent company at a wonderful price. But I won't be making this video any longer today. I want to thank you for watching and hope to catch you on the next one.